Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager out here at Charles Schwab. I am joined out there in the chat by my good friend, Connie Hill. Connie is a 20-plus year veteran in the financial markets. Connie has been the most frequent chat partner and support that I've had in this particular webcast. So I'm glad to have Connie here today. I'm glad to have her here all the time, but today especially because I've got a quick announcement that I'm going to make here in just a moment. But that being said, we're going to continue to talk through a number of the strategies we've been talking about regarding index options. We're going to kind of take a quick rundown of a couple of those strategies. We're going to look at some of the characteristics of index options that makes those strategies perhaps a circumstance where an index option is a frequent choice. That being said, welcome to all of you. We're glad to have you here in the webcast, whether you're in the live version or the recorded version. Either way, that's great. Connie's going to be there to help answer your questions in the live version. If you're in the recorded version, leave us a comment in the comment section. So a couple of quick housekeeping items as we get into this. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or solicitation of a particular account type or a particular strategy. Remember that past performance no guarantee future results. If you're going to trade options, remember that equity index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any options transaction. Also, remember that American style options, which most equity options are, allow for the possibility of early assignment. Index options, the majority of the index options, especially the ones that we talk about in this particular webcast, are what are referred to as European style, which means that the options cannot be exercised until expiration, which means it removes the possibility of early assignment on the short side. And so that's something to pay attention to make sure that you're aware of that. But that also lends itself to some of the strategies that we've been using. Number two, though, is because we're using the thinkorswim desktop software platform, specifically the paper money version of that platform. That paper money platform, great learning environment, but it doesn't do certain things that a live trading account will do. One of those is it does not facilitate the early assignment of short options. So just be aware of that as you're trading options. If you're trading an American style option and you are short that option, whether you're short a call or short a put, there's the possibility you could be assigned early, but it's not going to happen in paper money. If you're trading an index option that is European style, there isn't the possibility of early assignment, so you don't have to worry about it. But just be aware of that, especially also as you move your practice from paper trading to live trading, make sure that you're aware of some of those other differences, especially in the area of things like order fills and things like that. Those are going to be different in a paper money environment than they are in a live trading environment. We're going to be using some technical analysis in this discussion today. Remember that technical analysis is theoretical, as is probability analysis, as is fundamental analysis. None of those guarantees as to what's going to happen in the market, and the use of one of those by itself is not recommended as a sole means of investment research. One last thing I'm going to mention is that there is no guarantee when putting a stop order on that stop order will get filled at or near the price at which you triggered the stop order. So just be aware of that as you manage some of these strategies. So a couple of quick things that I wanted to talk through in terms of just reviewing index options and some of the strategies we've been using in this particular webcast. We've been talking about a lot of vertical spreads. In fact, the strategy that we use most frequently in this particular webcast, the 14 days to go until expiration, 7 days to go until expiration, relies on selling vertical spreads. But we've also put together those vertical spreads, those short vertical spreads, into iron condors, which makes it a little bit more of a neutral or range-bound strategy. We've done a couple of butterflies, but not very many. Butterflies are going to be very similar to an iron condor, but oftentimes there's some challenges to butterflies in terms of getting those trades to be put on. You've got 4 bid-ask spreads that you've got to cross. Um, Oftentimes you're selling two strikes at the money or very close to the at the money strike. And from a liquidity standpoint, sometimes that works, sometimes it doesn't. We've also used index options as a means to hedge positions, hedge an overall portfolio. Using an index option that allows for kind of broad-based, diversified hedging activity and delta reduction is a strategy that can be beneficial. So we'll kind of keep that idea going as well. There are a couple of other things that I wanted to mention regarding index options for those of you that are brand new. Index options, we talked about the European style aspect of it, the fact that if you're trading a European style option, those do not have that early assignment risk. Now, the next thing I'm going to say is very simply this. I am not a tax advisor. I don't pretend to be a tax advisor. I don't even play a tax advisor on TV. The closest I've come has been to play a tax cheat in a play in community theater. So I'm just going to say this, and that is there may be certain tax treatment advantages for using index options, but that's going to be something that each individual trader needs to consult with their own tax advisor for those particular circumstances. But some index options are traded a little bit differently than other options when it comes to taxes. That's as much as I'm going to say about that particular discussion. So let's pop over here to the Thinkorswim desktop software platform. But before I get into the discussion, because it's kind of been an interesting day, there's one thing that I wanted to talk about. And I said I had a real quick announcement. So I wanted to kind of get this out of the way so that we can just kind of run through the rest of the webcast. So one of the reasons why I'm glad Connie has been on chat support in this particular webcast for, gosh, the last year is that Connie has been listening to me teach this webcast again, week after week after week. And in fact, Connie has stepped in and filled in for me on times when I have not been available. So with that in mind, Connie is now, after this week, starting next week, Connie is going to be taking over this particular trading index options webcast. And there are a couple of reasons for that. One, my travel schedule in the next 2 months, 3 months gets really, really, really busy. I'm going to be out on the road a lot and with live events and in-branch events and in studio events. So I'm going to be in the Chicago studio, very likely in the New York studio for the Schwab Network, which is brought to us by our media affiliate, Charles Schwab Media Productions. And then I'm going to be out in our branch network doing some in-branch events, and then, of course, our live events. So what I wanted to do, and there's one other primary reason for this particular change, and that's what I'm going to show you right now. And I'm going to take you to the live webcasts and virtual workshops page. And we're going to come down here, and I'm going to go to June 1st. Here's June 1st right here. So June 1st, actually June 3rd is the first week that Connie is going to be taking over. And they haven't changed my picture on there yet, but Connie is going to be taking over that one on June 3rd. But starting June 1st, I'm going to be teaching a webcast series along with Jim Ferrioli from Schwab Trading on cryptocurrency basics. That's at 11 a.m. Eastern time. And we're going to do that every Monday. And so I get to take over that particular webcast. And Connie is going to take over this particular Trading Index Options webcast. So my thanks to all of you for being a part of this conversation. But I tell you what, and Will, you said it absolutely. Connie equals amazingness. Connie is going to be phenomenal at teaching this index options, trading this index options webcast. So I will still, I mean, nothing else is changing other than that in the rotation. So Connie's going to be teaching trading index options. I'm going to be teaching trading cryptocurrency basics. I'm still going to be teaching my trading futures webcast on Tuesday mornings as well. But now, one of the things that I'm going to mention, since I brought up the idea of this Cryptocurrency Basics webcast, I'd love to have all of you guys that are very active, that are that are curious, you are engaged learners. I'd love to have you come to our cryptocurrency webcasts on Monday mornings if you have the opportunity to do so, or if you have the opportunity to watch those in the recorded version. We're going to record those so that you can come back to a later time. So take a look at what's going on. S&P 500 index kind of giving us a bit of a little bit of a doji candle, almost a dragonfly doji today, and starting to see maybe that move to the upside potentially, but that could also be an indication of some deliberation, maybe running into a little bit of a resistance here. The Nasdaq, on the other hand, was a little bit more of a gap up, sell off type of candle here that started to come back up off of, and has been starting to come up off of its low for the day. So not abjectly bearish, but certainly a little bit of a deliberation candle going on here as well in the Nasdaq. Russell 2000, really kind of that equilibrium candle, a little bit more of a spinning top. You have an equal distance shadow top and bottom. So really just kind of sitting there and spinning and waiting, even though it's had 4 days consistently of gap up rally, gap down rally, and then gap up rally, gap up rally. So, you know, this is kind of an interesting perspective in seeing that move to the upside. Future now, thank you very much. Ricebird, thank you very much, and I appreciate that in all that you guys have done for me too. So let's take a look really quick at the VIX index. I'm going to pop back over here to the VIX grid, and we're going to take a look at what's going on in the VIX today. And again, one of those things that we're seeing going on is the fact that even though the market's just kind of sitting there, it's largely digested a couple of things. One, it's largely digested really positive earnings for the most part. It's also largely digested a lot of the geopolitical risk that is, depending on whose flavor of headline you're reading, still existent or non-existent, right? And so I think that's where the market has kind of said, fine, until we have clarity around that, we're simply going to proceed with, you know, for the most part, business as usual. So VIX is still now back on the 16.5 handle, right, kind of midpoint of that 16 handle. Yesterday, when we were trading the futures webcast, it was up around the 17 mark, so it's come down 1% in terms of that range. So, you know, I mean, this is a relatively, if we were thinking about 16 VIX, for the most part, this is kind of an average to low VIX, right? So we don't have a lot of volatility. What that means is that hedging is probably relatively cheap. If we take a look at the VIX and the VVIX, let me just grab these and move these around. So here's the VVIX. Remember, this is the volatility of the VIX. And we have the VVIX below the VIX. And we have both of those moving to lows. The price ratio of those two is moving kind of up towards that kind of magic ratio of 6 there, kind of where that is an indication that the VIX is becoming significantly volatile. So maybe there's a little bit of upward movement. What that would suggest, given the fact that we're kind of at the tail end of earnings season here, that we're kind of at that scenario where it's almost like saying in that horror movie, it's quiet out there, guys, too quiet. Because you see a low VIX and a lower VVIX, so lower volatility of volatility, that would suggest that maybe there is something afoot, perhaps, right? That this is the time when, you know, you keep all the plates spinning and then everything else falls, you know, when it is kind of in this scenario, right? So what we're going to look at today, I'm going to look at the possibility of maybe adding a little bit of hedging protection against the overall portfolio using index options as a means to do that. And then we're also going to kind of come back and suggest and talk about the idea of our 14-7 strategy. So let's do that one first, and then let's come back to the hedging. The idea here being that maybe it's a good time to buy umbrellas when it's not raining. Perhaps the best time to buy umbrellas is when it's not raining. But you run the risk of not needing the umbrella if it doesn't start raining. But when it does, you're glad for it. So I'm going to pop back over here to the monitor tab really quick, and we're going to take a look at the position that we have on here in our weekly strategy, our 14 days till expiration, 7 days to go until expiration, and then we'll kind of wrap back into our hedging strategy. So here's what we've got, and we've been doing this on a regular basis. I'm just going to do this really quickly and put it over here in our scratch pad so that we can see it. And that's my future stuff, so let's just do this. Let's go here. This is our, I'll kill that real fast. Delete, there we go. 14 DTE, 7 DTE strategy. And I'll just kind of line this out. So 1, we check direction of SPX. So that means above 200 SMA, we are bullish. Let me just do it this way. There we go, equals bullish. So likewise, below the 200 period moving average would mean bearish. So 2, bullish equals selling put spreads. And then what we're going to do is 3, we're going to select expiration 14 days till expiration. Next thing we're going to do is we're going to determine one standard deviation. So using probability of expiring cone, select strike. And 5 is sell put spread at selected strike 20 points wide. Now, we can make it whatever we want. That's just a starting point. That is not a rule of thumb. That is not an absolutely set in stone rule, but that's kind of the way that we line this out. So sell put spread at the selected strike, 20 points wide. Then 6 is buy spread back at 7 DTE, come what may. Okay, so whether we're taking a win, whether we're taking a loss, 7 days to go until expiration, we're going to buy that back, and then 7 repeat. Okay, that's the strategy. That's the 14 days till expiration, 7 days till expiration strategy. Modify at your leisure as you would like to. This is not proprietary. I'm not trying to sell you a book about this or anything else. It's just a strategy designed to instill consistency and probability, if you will. So let's come back over here. The trade that we put on last week was this one right here. We sold the, I'll bring that back up so you can see it again. 71.80 put. We sold the 71.80 put. We bought the 71.60 put. That was at about the 15-cent delta, so highly probable trade. We sold it for $2 even. Here we are at 7 days to go until expiration, and it's now trading for 25 cents. So this has done the majority of the work that it can do for us. Remember, the point of this trade is to capitalize on two things. One, not really a lot of directional movement. Two, the rapid passage of time, or the rapid decay of time value due to the passage of time in that first week of the trade. So this is a trade that we do every week. So we may get a little bit of a win. We may get close to a max theoretical gain. We almost always will not get to maximum theoretical gain. There's always going to be some remaining amount generally of extrinsic value in this particular strategy. So what I'm going to do is I'm going to close this one down. This has done all the work that it can do for me. I'm carrying all of the risk of the trade right now for remaining 22 cents, which doesn't make a lot of sense when it comes to the possibility of the market moving in the next week. So here's what I'm going to do. Salia, and I'm looking forward to meeting you in Santa Clara. We can talk a little bit more about it in person, but I'm just going to say this in general because we can't, unfortunately, in these demonstration accounts, share those performance numbers, if you will. But I will say this: over the year and a half, almost 2 years that we've been doing this, we've taken a lot more winning trades than we've taken losing trades, and we've taken some max losses. But those max losses have been overcome by the number of winning trades that we've taken, by the profit of the winning trades that we've taken. So just in general terms. Past performance, no guarantee of future success. Your mileage will vary. All right, so we're going to close this one down. I'm going to create a closing order. We're going to buy this one back for a quarter, and we're going to take that one off. It's done the majority of the work that it can do for us. And so we've now eliminated that for 25 cents. And now that obligation is gone, that trade is gone. Remember, it doesn't have early assignment risk because this is a European style option. So it could go close to being in the money. We don't have that early assignment risk. And our plan is to close this trade down prior to expiration anyway. So we don't have to worry about getting into that, 4-day window or so prior to expiration where that early assignment maybe becomes a little more likely. So I'm going to make these single options again. We're going to go back to that chart, and I'm going to change my grid to my index options grid. By the way, this index options grid that we've been using quite often is out there in the description of this webcast, but I'm going to share it with you again. Remember, anytime we share anything, it is for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. So I've shared that out there with you. So here's the S&P 500. The blue line is our 200-period moving average. The S&P 500 well above the 200-period moving average. Now, there's one challenge to this particular strategy, the way that we've written this out, right? The way that we've defined being bullish versus being bearish. Because you see how far above that 200-period moving average we are on the daily chart? There's a long ways for this index to go down before it were to cross below the 200-period moving average. So one tweak that some traders, I know some of you have already done this, is maybe using a faster moving average to make your definition. Because where this particular strategy runs into some challenges, using index options or otherwise, is in that transition point between the index being bullish or bearish. Because that's when you get whipsaws. And it's those whipsaws, even with rapid time decay, even without the potential for early assignment, whipsaws in short verticals that are not very directionally sensitive certainly don't help you and can potentially hurt you. So that's something to pay attention to. And if a trader were going to adjust this and customize it, make it their own, that might be a place to start, would be adjusting the length of time on that 200-period moving average, maybe making it a 50 or a 30-period moving average. Try it out and see. So anyway, what we're going to do is we're going to go to our time hack, which is over on the right-hand side. And it's just one of the drawing tools. It is simply this time level. And we know that our 14 days to go until expiration time frame on the SPX is right here. It's the 10th of June. How are we in June already? That is insane to me. So talking about time rapidly passing and rapidly decaying, right? All right, so we're going to move this out to the 10th of June, 6th, 7th, 8th, 9th, 10th. And we're going to drop that in place. There it is right there. Whoops. There it is in place on the 10th of June. Now we're going to take our line tool and we're going to draw right across there. 7290 is our intersection. 7290 is our intersection right there. We're going to draw a hack right there, just a hash mark. And we're going to say, all right, let's go back to the trade tab. Let's go to our 10 June expiration. And we're going to go to our put sides. Our put side over here, we're going to go to the 7290. I fortunately have a 7290 strike. 14 cents a delta, not a lot of gamma because we're still 2 weeks away from expiration, but that's going to gain some gamma if it starts moving closer to the at the money strike. But at the 14-cent delta, we're far out of the money, and we're far out of the money enough that gamma is not going to be a big issue generally. But we got a lot of theta, and that theta is going to be rapid between now and next week, and then it's going to slow down. So we can benefit from that. We're sucking $1.73 out of this option premium every day that goes by. But then we get to next week and it's going to be in that kind of area where it starts to slow down a little bit. The Vega is pretty sensitive too. I mean, with $3.30 here of Vega sensitivity. So if implied volatility goes down, wow, that works in our favor. So if the SPX keeps going up, VIX keeps going down, that's going to definitely benefit this particular strategy, right? So we're going to sell the 72.90 and we're going to buy the 72.70, right? That's 20 points, isn't it? Yeah, 72.70 is the one that we're, or excuse me, 72.90 is the one we're going to sell. 72.70 is 20 points away, right? 90, 80, 70. Yeah, 20 points. Had to check my math there. Okay, you remember last week we got $2 for this same 20-cent, or excuse me, $20 wide vertical spread. Now we're getting $1.80. But last week VIX was up around 18, up in the 18 handle. This week we're down at the 16 handle. That's the difference in just a couple of percentage points on the VIX in terms of the amount of premium that's available here, which speaks to the idea that hedging premium is pretty cheap at the moment. Call side may be skewed a little bit because I think there's still some upside potential here. We talked a little bit about skew a couple of weeks ago. And while I've been talking, notice that this is banging around between $1.80 and $1.70. So I'm going to go confirm and send. That means that our max loss on this trade is going to be a little bit larger. But that's okay because remember, this is a highly probable trade, number one. And number two, what would it take for us to get to that max theoretical loss? It's going to take a pretty big move in the price of the stock. We're at the 14, or the price of the index. We're at the 14-cent delta. So it's going to need a big move. Now, big moves can potentially happen, especially when we're talking about a circumstance where volatility is low. Remember, guys, it's quiet out there, too quiet. And then the serial killer comes around the corner with the knife, right? So just be aware of that fact, that low volatility breeds complacency, and complacency breeds getting killed by a serial killer or a moving index. All right, so what we're going to do is we're going to put this down in our index options weekly group, and we're going to click on send, and we're going to fire this off. After we read through it, make sure that this is what we want to do, right? So selling the 72.90, buying the 72.70, creating that short put vertical spread, bullish in nature, and we're going to fire that order off, and we're going to see what we get. And we got it. We got it for $1.80. Cool. Okay, we got it for $1.80. So now what we want the price of the index to do is still stay up, still go up above where it is now, still move in bullish direction, or not move down very much. But remember, this isn't very directionally sensitive at all. So let's do this. We're at 1, 2, 3, 4 strikes. So let's do this. I'm just going to change this layout here to vertical spread. 1 month, let's do 1 month, 4 strike vertical. And that should give us our 72.90. Where is it? 72, 70, 72.90. There it is right there, 72.70, 72.90 vertical spread. So we've got about 1 cent of delta sensitivity. Not very directionally sensitive at all. Doesn't really bother it much if the price of the index goes up or if the price of the index goes down very much. No gamma, 9 cents of theta remaining, and about 23 cents of volatility remaining. So, wow, in this particular case, given what those theta numbers are, and you notice that they're different out here. In a lot of cases, you're going to see some of these strikes that maybe you've been trading a little bit longer. They have slightly different theta numbers, and there's some reasons for that, just in terms of in terms of volume and open interest. But this becomes more of a volatility play almost even than it does a time decay play. But we can put both of those factors to work for us, right? Implied volatility, high and falling, works definitely in this case. So that's our short put vertical spread. Let's come back over here. Here's the one that we've got coming out of this class, which is 14 days to go until expiration. 72.90 put we sold, 72.70 we bought. Let me just bring that up real quick. And again, while I'm changing some of these charts, I'll leave that there so that you can write that idea down if you have not done so already. All right. So what I want to do is I want to come back over here to our monitor tab one more time. And I've got a group here in my monitor tab in my position statement called beta weighting. And this is just simply a group of long stock positions. It could also have, you might also have in this long stock portfolio, I'm going to move a couple of these here. You might also have some option positions as well. So I'm going to move a couple of option positions into that group because they're going to have their own deltas as well relative to themselves. So I've got a negative delta PayPal position. I've got a positive delta Target position. So one's a short, probably a covered call, I'm guessing. Yep, one's a long put. One is a long call. So I've got different kinds of deltas in there. I've got stock deltas mixed in there. All I've done is I've added this column that says delta. So what I want to do in this particular case is convert all of those into a common number because these are all related to each other, to themselves. Those are 300 Amazon deltas and 100 Boeing deltas and 100 Microsoft deltas and 17 Coca-Cola deltas. Trying to hedge each one of those is going to be pretty expensive. But if I come over here and I beta weight that, and I beta weight it to one of our indexes. So the majority of these, if you take a look in here, the majority of these are, got Amazon, Avigo. I mean, these are all large cap stocks. I've got a number of technology stocks. So probably beta weighting this portfolio to the S&P 500 index or to the NASDAQ index. Probably not the Russell 2000. Maybe not as sensitive to the Russell 2000. So for the sake of clarity and kind of keeping these separate, I'm going to use the smaller version of the S&P 500 index options. So we could use /SPX, and we could, just SPX, and that would beta weight this whole portfolio to the S&P 500. So we're long about 112 S&P 500 deltas. But I'm going to use XSP, which is the smaller, the mini S&P 500 index. And so we're long about 1,100 XSP deltas. So what if I wanted to keep that bullish directionality, but I wanted to bring that, that sensitivity down by, let's say, 100 deltas, right? By 100 deltas. Remove the 100 deltas of that sensitivity out of this equation. So what I can do to manage that, there are a number of different ways. We could simply buy puts on each one of these individual stocks, but like I said, that's going to be costly. But we can come over here to the trade tab, and we can put in XSP. Now, this is going to be a little less efficient, right? Because this is the smaller index. But I wanted to keep this separate. So then our SPX trade. So if my thought is that, we're kind of at the end of earnings season, we're going to a new quarter, so we're going to have a new earnings season coming up here soon, right? January, February, March, April, May, June. Yeah, so end of next month is going to be the end of the next quarter. So what I'm going to do is I'm going to go out here at about 34 days or so. I'm going to go out to the 30 June expiration. So that's a little bit of time out there. I'm going to make these single options and I'm going to buy something that gives me some negative deltas. So if I were to come down here and I would say, all right, fine, I'm going to go out to maybe, and this is where I'm going to use delta as a measurement. I'm going to go to an option and I'll just take a look at this. I'm going to use an option. This is the 732 strike on the XSP, which correlates to the 7320 level on the S&P 500. And if I were to buy one of those, let me show you what that does. So we're going to buy one long put option. Now it's going to suffer from time decay. And it's going to be a decaying, wasting asset. It's going to be a long option. But it reduces some of the sensitivity in the near term of my portfolio that I'm beta weighting to negative movement in the S&P 500, adverse movement. So I'm going to click on confirm and send. I'm going to put this in my beta weighting group, and I'm going to send that order off. Now, that's going to be $580 for that contract. So this is not going to be cheap to offset some of this potential risk. Now I can see that I've reduced about 25 deltas out of that equation. So we were at about 1100. Now I'm at 1098 or so. Now, if I were to do another one, you see I took out 25.46 deltas. So if we were to do this, if I were to go back to my trade tab and I were to sell, or excuse me, I were to buy three more of those. 1, 2, 3. So that's going to be another $1,500, $1,700 to buy those. Again, not going to be cheap, but it's going to offset. Now I'm long 4 contracts of that XSP, and I've reduced my deltas by about 100 deltas. I'm still sensitive to upward movement, but I've reduced some of that exposure if this overall index starts to move down. Now, could we have done that with SPX? Yes. Let's look and see what that change would have been. So I'm going to come back over here. We're going to change this to SPX. And if I were to do exactly the same thing, if I were to go to the 7320, I think is where we were, 7320. Now here's where the challenge lies, right? Because this is a little bit more efficient. If we were to do this, keeping it beta weighted to XSP, if I were to buy one contract, that's going to be $1,900. Let's put it in here and see what that looks like. This is one contract of the SPX, 10 times the size of the XSP, and I beta weight that portfolio. So I bought that for $1,900 for the contract. I go back over here to the monitor tab, and with that one contract, I reduced about 160 deltas. So you need to be aware as you're doing this beta weighting and hedging your portfolio, especially when you have a diversified portfolio, what instrument you're using, what form of that instrument you're using, because we've used XSP, the smaller index, we've used SPX, the larger form of that index, to try to hedge that. So our cost on the SPX was about 1900. Our cost on reducing about 100 XSP deltas was about $2,000 to remove those deltas. So the more efficient way to accomplish reduction of deltas in this particular case would be to buy the the SPX. So I just wanted to demonstrate that difference, but I kind of wanted to keep it separated just so that we could see those two. We're not muddling up SPX versus XSP. So what we've done in this case is we've reduced the sensitivity of this portion of our portfolio that we've beta weighted buy now 260 deltas, still bullishly long, but we've got a couple of different hedges that we can work with. Now, the thing about it is, you got to remember when hedging that a hedge designed to protect against adverse movement or to offset adverse movement is not intended to be, nor is it designed to be a money-making opportunity. You don't intend to, you don't go into a hedge with the intent of making a profit on that hedge. I will tell you, in the conversations that I've had with traders, with active traders who use hedging strategies, that is by far the most common question that I get. I put this hedge on and it's losing money. What do I do to change it? And my answer is always the same. It was designed to lose money in and be there as a protection in the event of an emergency situation. So it was never intended to make money to begin with. So a hedging strategy like this one, buying a put option on an index option, isn't intended to be a money-making strategy. It is intended to be a money protective strategy in the event of adverse movement. You buy an umbrella to protect yourself. You don't open the umbrella up, at least in most cases, you don't open the umbrella up for fashion purposes or for the opportunity to to flip it upside down and catch the rain. Does that make sense? Maybe that's a bad metaphor. Anyway, at least that gives us an idea. So once again, what we've done is hopefully illustrated some different ways that you can use index options. We've illustrated some ways that you can be consistent in these strategies. I'm going to pop this right back over here one more time so that you can see it. Again, I'm going to put that index options grid on my VIX grid in the description for this particular webcast. But if you want to go back to all of those previous webcasts that we've taught, come back over here to the YouTube page, youtube.com/@TraderTalksWebcasts. And this is going to be your personal repository of all things educational. Gives you the opportunity, if you search for trading index options, to get to the playlist for trading index options and all of those individual webcasts that you can go back and watch on a regular basis. All we ask is you click on that subscribe button when you do that. So give us a follow on social media. I'm still there. Connie's still there. We're on X. I'm at Ben Watson CS. Connie is at Connie Hill CS. I'm also on LinkedIn. I think Connie's going to be there pretty quickly as well. For those of you that are going to be joining us this weekend, I'm going to pop back over here to our in-person events. We're going to be in Santa Clara this weekend doing our Advanced Option Strategies workshop. We're going to be in San Diego the weekend following doing technical analysis and option strategies. Then I'm going to be in Chicago in the middle of July, but I'm also going to be in Chicago doing some stuff in studio at the end of June. And then we're going to be in Dallas. But here's one that you might be interested in. I'm just going to highlight this one right down here. I don't know how many of you have seen this, but November 20th and 21st, and perhaps one other date, we are going to be in Honolulu, Hawaii, doing a technical analysis and option strategies workshop. So if you want to come and spend the week before Thanksgiving with us in Hawaii, we would love to see you there. The event is no cost to you. Getting there, that's a different story. So we look forward to seeing you there. Once again, my thanks to Connie Hill for helping out and for being willing to take this over and jump into it. My thanks, of course, is to all of you for being in this particular webcast and being here and being great students. Thanks for joining me week after week after week. I'll see you on Monday mornings talking about cryptocurrency. Take care, everybody. Have a great day. We'll see you in Santa Clara. Bye-bye.